Hi, I'm Jimmy Lepping, a psychologist and statistician with an interest in innovation in education, psychology, healthcare, and analytics. And one of my weekend activities is studying the financial markets and what happened during the week that is coming to an end. In that exploration of the financial markets, I combine different perspectives, fundamental and technical, short term and longer term, and from different units of analysis, in order to inform myself about what is going on and what I want to do with that information. On my YouTube channel, which I started just a couple of weeks ago, I share videos in different themes, one of which is financial markets, and in that category I have started to share and will continue to share examples of analysis that I perform from these different perspectives. And in this video I provide an example of the type of mid and longer term analysis of relations between different types of subjects in the financial markets. More precisely, in this video I explore relations between different paper currencies, cryptocurrencies, stock market indices, as well as metals, oil and natural gas, through a network analysis and so-called cross-correlation functions of week-to-week percentage change, measured from one Friday's close to the next Friday's close, taking the euro as unit of analysis from late April 2021 until this week's market close, Friday 27th of October 2023, or 2023 year to date. I will explain each of these subjects and concepts as we move forward together in this video. Before I get started, if you are doing your own analysis of the financial markets or are trying to make a start with this and you are interested in some of the tools I use for these analysis, you can either leave a comment below this video or send an email to the address in the description below this video, which I also share on the screen at the end of this video. Having said, I will make two comments on where I get my data from and which kind of software I use. For the data, one of the websites I use on a regular basis and have also used for the analysis in this video is Yahoo Finance. Yahoo Finance allows one to download data from a wide range of subjects in the financial markets, including the ones that are part of this video, as well as individual stocks of a tremendous amount of companies. This gives you daily open, high, low and closing prices per subject for the time period you specify. All this data is stored in CSV files, which I then read in open source software packages of R, JASP and Jamovi, depending on what kind of analysis I want to perform. This network analysis, for instance, was performed in JASP, which is a great program for a wide range of types of analysis, including network analysis. So what we see here are two networks on the relations between a total of 14 different subjects in terms of their percentage week-to-week change, when expressed in euro. Using the euro as unit of analysis has two reasons. First of all, I, who do the analysis, am a European Union citizen and use the euro in all my financial transactions. And in addition, many of the analysis shared on the internet via prices, price changes and relations between different subjects are in US dollar terms. And I want to illustrate that the strength of relations between different subjects of interests may be quite different when we use another unit of analysis. In each of the two networks here, the 14 nodes represent the different subjects under study. In green, the paper or fiat currencies, US dollar, pound sterling and Swiss franc. In purple, the cryptocurrencies, Bitcoin, Ethereum and Binance. In orange, the large and mega cap stock market indices, S&P 500, the German DAX 40, the Dutch AEX, and in yellow, gold, silver, copper, oil and natural gas. Blue lines indicate positive correlations, while red lines indicate negative correlations, and thicker lines indicate stronger correlations than thinner lines. Next, the network on the right uses the same data, but a different estimator, which helps to understand the most important relations in a network. I tend to use these two networks in combination to see relations of interest and to make sense of relations between these different subjects under study. So what do we see here? First we see a clear crypto cluster with positive intracorrelation, meaning that weeks of more positive changes in one cryptocurrency versus the euro tend to go hand in hand with more positive changes in the other two cryptocurrencies versus the euro, and less positive and more negative changes also tend to be shared among these cryptocurrencies. In other words, although there can be considerable differences in performance between these cryptocurrencies in a given week, depending on the news, across the trajectory of the past 30 months or 2 years and a half, we see that really more often than not, they move in the same or at least similar direction. Second, we see a similar pattern for the stock market indices, especially between the DAX and the AEX, which are the two European indices included in this network. Third, among the paper currencies, we see somewhat weaker relations, although the more substantial relation here is between the US dollar and the Swiss franc, two currencies that have traditionally been seen as somewhat of safe havens in times of turmoil. Whether the US dollar and the Swiss franc actually are safe havens remains a question of ongoing discussions, but at least many people think they are safe havens, so one tends to see a movement towards them in times of turmoil or certain types of concern that tend to result in moves from so-called risk-on investments to perceived safe havens. It is therefore not really surprising to see that the two European stock indices AEX and DAX are negatively correlated with the US dollar. Finally, in the fourth category, which I have called matter and presented in yellow, we see positive relations between gold and the two more industrial metals, silver and copper, and especially between gold XAU and silver XAG. Of these three metals, the one most substantially correlated with oil is copper, which makes sense because in times of increased economic activity there is more demand for both oil and copper, whereas in times of recession or fear of recession, the prices of oil and copper tend to go down because the demand, in times of recession, the demand for oil and copper tends to decrease. And of course, natural gas has had wild swings up and moves down in the course of the past 30 months with almost absurdly high levels sometime last year, and currently values which are, well, still somewhat elevated, but much closer to the price levels seen before the run-up than seen during last year's highs. These networks are helpful in my view to see in order to see how different investment classes behave in a given time window and help to appreciate certain expectations and assumptions from a different perspective. For example, gold and the US dollar are often believed to be negatively correlated, whereas in this network we see that if there is a correlation between gold and the US dollar, it is probably modestly positive instead of negative. And from the perspective of the euro, this makes perfect sense because in times of geopolitical turmoil or unrest in financial markets for other reasons, we see a move into both the US dollar and gold. And the fact that this correlation is only modestly positive can of course be explained by the fact that, well, some kinds of concerns in markets tend to result in more of a move into the US dollar, while other kinds of concerns tend to result in more of a move into gold. But important, when expressed in euros, we don't see that negative correlation between moves in the US dollar and moves in gold. That said, the networks we just saw indicate correlations between subjects using the data of the same trading week, or so-called lag zero correlations. In time series data, there is serial correlation. At the level of an individual subject, this means that given price levels of past weeks, it is to some extent possible to define a range of price levels we may see for that subject at the end of next week. In other words, movements in this kind of time series are not exactly random as one might expect in a casino. And this is one of the several reasons why I reject the notion that financial markets are one big casino. Yet when we work with day-to-day or week-to-week differences in price levels, the serial correlation is much weaker, and for many subjects around zero, not exactly zero, but around zero, or more precisely, often fluctuating in intervals of say minus zero point 0.1 or minus 0.15 to plus 0.1 or plus 0.15, values that indicate rather weak correlations. At the next level, we see what we see here, a so-called cross-correlation function, which indicates the correlation between moves into subjects as a function of the number of lags difference in time. So for example, here we see the cross-correlation function of gold versus the US dollar, with gold on the left and the US dollar on the right. If we had a substantial positive correlation at lag -1, for instance, that would mean that a move in percentage difference versus the euro in one given trading week for gold could have some predictive value for moves in the same direction for the US dollar 1 week later. We do not have such a substantial correlation in this case, but I'm just using this as an example to explain the concept of lags in a cross-correlation function. Likewise, a substantial correlation in one of the positive lags would mean that not gold moves are a leading indicator for moves in the US dollar, but the other way around. Gold would in that case be a lagging indicator of the US dollar because the US dollar would be a leading indicator of gold changes. In this case, we see no substantial correlations across the spectrum measured, which includes the current or same trading week, lag 0, plus and minus 13 lags or 13 weeks, hence about 1/4 of a year at either side of lag 0. So again, as we saw in the networks before, we do not see any substantial negative correlation between gold and the US dollar, as is often talked about in the financial markets when things are expressed in other units of analysis. What we do see in this time window is a fairly strong positive correlation between gold and silver, which we also see when we express, by the way, these metals in the US dollar instead of in euro. More precisely, at lag 0, when expressed in the euro in this analysis, indicating that changes in gold in a given direction tend to go hand in hand with changes in silver in the same or at least very similar direction. The correlation is 0.75. When expressed in US dollar terms, we have traditionally also found correlations between gold and silver in that range, or even of about 0.8. Also fairly substantial is the correlation between stock market indices, as we already saw in the networks, although not as strong as sometimes stated. If I showed the cross-correlation function of the AEX and the DAX, we would see a stronger correlation, or about 0.86. Yet for the American S&P 500 and the Dutch AEX, we find, well, still a substantial correlation, but only about 0.63. Squaring this number would give an indication of the percentage of variation in one index explained by variation in the other index, which hence would be about 40%. Although this is substantial, it helps to shed light on the at times bold statement that what happens in the US stock market has a 1-to-1 or 100% relation with what happens in the European stock market. As this function clearly indicates, there is a substantial relation between what happens in the US and what happens in Europe in a given trading week, but to say that it is perfectly related would be an exaggeration. Then, here an example of a negative correlation. There are not many in our network, but between the US dollar and the AEX index, we see a negative correlation of about -0.4, which is not strong but still substantial, meaning that variation in one of these explains about 16% of the variation, 0.4 squared, about 16% of the variation in the other. For the US dollar versus the DAX, we would see something similar, with the lag 0 correlation being about -0.43, so of about roughly the same kind of magnitude as for the US dollar versus the AEX. Then here, one more cross-correlation function to illustrate what is happening in the crypto space, where Bitcoin and Ethereum maintain a correlation over 0.8, which is really an indication that despite all the talk about how different one cryptocurrency is from the other, at the end of the week they usually show a very similar performance. Yes, in specific weeks there can be clear differences in response to specific news, for example, that relates more to one cryptocurrency than to the other. But on the longer run, we see that, well, more often than not, they really have a strong covariation in the same directions. Finally, I also wanted to share a chart in which on the horizontal axis we have the median weekly percentage change, and on the vertical axis the interquartile range, which is a measure of dispersion of the weekly percentage change, to see how these 14 subjects have behaved in the 30-month period. Note that the median weekly percentage change is not an indicator of the value of a subject in euro now relative to 30 months ago. All it does, having ranked the 131 weeks of data for each subject from low to high, or from most negative to most positive, and then we take the middle value, which is the week ranked 66th in terms of weekly performance of that subject. So if there were more negative than positive weeks for a given subject, that subject will have a negative median and hence be positioned towards the left in this chart. Whereas if for a subject there were more positive weeks, positive change weeks than negative ones, well, that subject will have a positive median and for that reason be positioned relatively more towards the right in the chart. The other dimension, the vertical axis, provides a measure of volatility or changes in trend for a given subject, with subjects higher in the chart having shown higher volatility than subjects lower in the chart. In addition to the positions of each of these 14 subjects under study, I have defined 4 clusters based on the combinations of these two measures or dimensions used. First, below we see that paper currencies, the US dollar, the Swiss franc and pound sterling, constitute the category of relatively lowest volatility versus the euro. Versus the euro because that has been the unit of analysis all along. Second, in the center we see a cluster that includes both the stock market indices and the 3 metals included in this analysis, which is a cluster that compared to the paper currencies has been slightly more volatile, and each of the 6 subjects in this second cluster has a positive median percentage change in this time window. Third, we see in the upper left and middle of the chart the 3 cryptocurrencies studied, which differ considerably in the median percentage change, but have in common that they have been considerably more volatile than the subjects in the first 2 clusters. And finally, I have marked oil and gas as a 4th cluster because although gas has been considerably more volatile than oil, both oil and gas score higher on the volatility measure than the subjects in the first 2 clusters, gas even more than any of the cryptos, by the way, and both oil and gas have a clearly elevated median percentage change relative to other subjects. So, to conclude, this analysis demonstrates that from the perspective of a person who uses the euro in all financial transactions, different clusters can be seen in a range of commonly traded and invested subjects in the financial markets, with the clusters of paper currencies, cryptos and physical subjects clearly moving in different directions or moving like with weak relations. Now, within each of these clusters there are substantial relations, but between clusters the relations tend to be quite weak. And well, even within the cluster of physical subjects, the metals behave fairly differently than do oil and gas. There isn't a negative correlation between the US dollar and gold, as is often talked about, from different units of analysis, and although considerable negative correlations can be seen between, on the one hand, the US dollar and on the other hand, the 2 European stock market indices, they are by no means perfect. And this would not change, by the way, if instead of the DAX and the AEX, I included the French CAC or the Spanish IBEX instance, for instance, because these major European stock indices have a strong positive intercorrelation, as I also discussed in a video that I shared last week. So that's it for today. Thank you for listening. And if you have any comments or ideas or suggestions for future videos, you can leave a comment below this video or just drop an email at lappinganalytics@gmail.com. Have a good day and see you soon.